Hi everyone. So I just want to continue on the theme of Q&As that we've been doing there recently. So this week we just cover off maybe another 4 questions. The first one of these is, what's the tax on an investment fund? So everyone will be aware of deposit interest retention tax. So that applies on any funds held within a banking institution. The exit tax is different on an investment fund. It's classed as an exit tax, and it's taxed at a 41% rate. It's only on the growth within the fund. So no matter what you've invested, that's outside the scope. It's only on the growth within it, and it's taxed at 41%. How it's applied, there's two kind of, I suppose, dates really. The first one is your encashment date before 8 years. So if you encash or withdraw from your fund within those first 8 years, what you have is a deduction at source by the provider, and they take care of the tax piece of it. If it's after 8 years and you haven't made any encashments or withdrawals at that point, the government apply what's known as a deemed distribution. So in year 8, there's a deemed distribution. The gain is calculated at that point in time, and the tax is withheld and paid over to revenue. At a later stage, when you do make a withdrawal or encashment, that first period, those first 8 years, is already been paid for, and it is taken into account, so that you're not double taxed on it, but it is already taken into account. The second question we have is, my bank is closing, I have savings and a mortgage with them, what do I do? So the one thing to remember here, this is really in relation to Ulster Bank and KBC, and while there are agreements in place with other institutions in relation to transferring accounts, transferring mortgages and things like that, there's a number of things you really should be looking at here. So from a savings point of view, any savings held within a banking institution are obviously earning 0% right now. It is something that you should be looking at. Look to see if you can maximize your savings. Look at investment funds, look at investment options, see what's available to you in terms of those and what you could actually get from it. So that's the saving side of it. The mortgage side of it, again, it's the same thing. While you may be on a particular rate with a bank, let's say a fixed rate, right? So your fixed rate will transfer over to the new institution, and at the end of your fixed rate period, then it's recalculated and they'll give you a new rate. If it's a variable rate, again, it transfers over, but it is subject to what the new provider is currently charging on their variable rate. So it's important to look at what rates are out there on the market and see whether or not it's worthwhile switching your mortgage from Ulster Bank or KBC, or even the new provider if it's already moved over, to another institution, and see if you can actually avail of a better rate of interest for yourself. Again, that's just a switcher mortgage. It's very easy to do. It makes it an awful lot easier rather than buying the house in the first stage, where you're under less pressure because you already have the mortgage in place. So it's not as stressful as dealing with the mortgage drawdown on day one. The next question we have is, so I've got an inheritance recently. Should I use this to pay down my mortgage? Everyone is going to be different on this one. My own thoughts are that no, I wouldn't. If you have a situation where you have a mortgage on one side and an investment on the other, and something happens to you, you get sick, you can't work, you're out of work, at least you have the investment, you have the money sitting over here in that investment fund or in the bank or wherever you've decided to keep it, and you're actually being able to use that to then pay your mortgage, but also to pay your bills. If you take the alternative where you've used that money in total to clear down your mortgage and you're now not working, the bank is not going to advance you any further credit. They want to know that you can repay them. They're not going to be able to do that if you don't have a job now, or if you're ill, or if there's other issues. So my own view is, always maintain your investment fund, always maintain your own funds separate. Yes, you're paying an interest rate on the bank, as I've mentioned earlier. Have a look around, shop around, see if you can actually get the best rate, the lowest rate applicable for the mortgage, and then try and invest your funds separately so that you're getting some element of return on that. At the very least, just try and negate the interest rate that's being applied to your mortgage by the bank. But maintaining that fund separate is, in my opinion, a huge benefit for you, rather than actually clearing down the mortgage. The last question we have here is, how do you track down old pensions? So this is something that is really starting to be looked at by a lot of people. So people will have moved jobs over the years. Not only will they have moved jobs, they'll have moved houses, they'll have changed numbers, they'll have changed email addresses maybe. And so the pension provider from those older jobs have no way of contacting you. You may remember that you had a pension with them, but you have no details on it. So our job is to actually go and find them for you. So what we do is we get you to complete a letter of authority. We identify the companies that you've worked for, and we contact the pension providers and find out what was actually there. Now, in some situations, we discover that you never had a pension with them, or that you drew down that pension early, you encashed it because you had been less than 2 years there or something. You know, there's a number of reasons, or you've transferred it on to someone else, or into another new employer. But at least you have a better idea now of where everything actually is. So again, it's a very simple process. We complete all the paperwork and we get you to sign it, which just identifies that we can actually talk to these providers for you. And it does, in most cases, yield, I suppose, a significant surprise for people in terms of what they've had in the past. So that is pretty much it for this week's Q&A session. If you have any specific questions, I know we've had a few in that are kind of specific to people. Email them into either myself or Tracy. So it's literally just our first name at oaktreefinancial.ie. You can contact us here in the office on 025 305 88. Or if something has resonated with you and you want to book a call with us, you can book that on oaktreefinancial.ie. So thanks again.